Google reports earnings on April 24th, and with the stock down 27% from its peak, this could be the deciding moment for investors. Today, I'll show you exactly what you need to watch when the numbers drop. Will Google's massive AI investments finally show returns? Or will regulatory headwinds push the stock even lower? I'm breaking down the 3 key metrics that will determine Google's fate, including one that most analysts are completely missing. Google has fallen hard from its February peak of 207 to just 151 today. That's a 27% crash in 2 months, and now it's sitting just 7.5% above its 52-week low. The big question, is this the bottom, or is there more pain ahead? This chart tells the story perfectly. While the S&P is up 8% this year, Google has plunged nearly 23%. That's shocking for a Magnificent 7 stock. The recent antitrust ruling was the final blow that pushed Google to technical support levels. This is truly make or break territory. Wall Street expects revenue of $93.5 billion, up 10.7% from last year, with earnings per share around $2.02. But here's what really matters: operating margins and cloud profitability. Beating these numbers isn't enough. Google needs to show its $75 billion AI investment is starting to pay off. Google's quarterly revenue growth has been consistent, but not accelerating. Last quarter, they hit $96.5 billion with 11.8% year-over-year growth. For Q1, analysts expect a slight slowdown to 10.7%. The problem? With all this AI investment, investors want to see growth accelerating, not slowing. Here's where it gets interesting. Despite pouring billions into AI, Google's margins have actually expanded from 25% to 32% over the past year. This remarkable efficiency is unique at Google's scale, and continuing this upward trend is absolutely critical for maintaining its premium valuation. Earnings per share have jumped from $1.64 to $2.15 in just 3 quarters. That's 31% growth, far outpacing revenue. This comes from improving margins and aggressive buybacks. The green bars show how consistently Google beats estimates. They've topped expectations by an average of 11% over the past year. Google's balance sheet is nearly bulletproof, with $95.7 billion in cash and just $10.9 billion in debt. This fortress financial position gives them massive flexibility to weather any storm, whether it's regulatory fines, economic slowdowns, or funding their AI ambitions. The cash flow story is even more impressive. Google generates $39.1 billion in operating cash flow quarterly and $24.8 billion in free cash flow, up 41% year over year. Even after massive AI investments, they're still generating billions in excess cash to reward shareholders. Few companies on Earth can match this. Google Cloud has transformed from a money-losing operation to a genuine second growth engine. Revenue has climbed steadily to $11.35 billion, growing at an eye-popping 52.3% yearly rate. While still behind AWS and Azure, Cloud is now profitable and could become a much bigger piece of Google's future. Looking at Google's overall revenue mix, search still dominates at 58%, followed by YouTube ads at 15% and cloud at 11%. Despite diversification efforts, Google remains heavily dependent on advertising revenue, about 80% of total revenue. This makes their ad market performance absolutely critical to their results. The contrast between business segments is stark. Google Services drives 90% of revenue with impressive 39% margins, but slower growth. Cloud is growing twice as fast and finally profitable with 8% margins. Meanwhile, other bets like Waymo lose money at an astonishing 409% margin. Bottom line, while ads fund everything, Cloud is emerging as the growth engine that could boost future earnings. Google's facing mixed signals from recent events. On the positive side, they've acquired Wiz for cloud security, announced Gemini 2.5, and partnered with PJM for AI power grid optimization. The negative? A major antitrust ruling against their ad business, regulatory orders in Japan, and potential forced Chrome divestiture. Innovation versus regulation is the key tension here. From a technical perspective, Google faces resistance at $167, the 50-day moving average, and $173, the 200-day. Breaking above these levels would signal a potential reversal. Support sits at $146 and $140. The RSI at 45 is neutral, suggesting the stock isn't oversold yet. But volume is drying up, potentially forming a bottom. Google currently trades at a massive 27% discount to its 5-year average PE ratio. When a company of this quality trades at such a discount, it's worth paying attention. The question is, are lower multiples justified by slowing growth and regulatory concerns, or is this a market overreaction creating opportunity? Compared to both the broader market and tech sector, Google trades at significant discounts. This chart shows Google at a 23% discount to tech peers and 27% below its own historical valuation. For a company with Google's market position and profitability, these discounts suggest potential undervaluation. Wall Street remains overwhelmingly bullish despite recent concerns. Out of 66 analysts, 82% rated a buy or outperform with 0 sell ratings. This strong consensus suggests professionals see the current price as a buying opportunity, with regulatory fears potentially overblown. The average analyst price target sits at $205, suggesting 35% upside from current levels. What's interesting is the gap. Targets range from $159 to $250, showing significant disagreement about Google's fair value. Even the most bearish target is still above today's price. Google has consistently beaten earnings estimates, but market reactions have been mixed. They crushed Q1 2024 by 25.6%, driving the stock up 3.8%. But after Q4's small beat, the stock actually dropped nearly 2%. The key takeaway? The market cares more about guidance than past results. Analysts project accelerating quarterly revenue throughout 2025, from 10.7% in Q1 to over 14% by Q3. Annual revenue growth is expected to maintain around 11% through 2026. The storyline here is clear. AI monetization and cloud expansion should drive consistent double-digit growth. Google is betting big on AI, $75 billion big. That's 20% of their annual revenue. Their Gemini AI suite is advancing rapidly, with Gemini 2.5 Flash launching this quarter. The most critical metric for earnings? Any timeline on monetizing these massive investments? Without a clear path to revenue, these investments will continue weighing on the stock. Breaking down that $75 billion AI investment, nearly half goes to infrastructure, 28% to R&D, 15% to talent, and 11% to acquisitions. This spending has nearly doubled in just 4 years. The billion-dollar question that keeps investors up at night: when will these investments start generating significant returns? The digital ad monopoly ruling represents Google's most significant near-term regulatory risk. The Justice Department ruling could force structural changes to Google's core ad business, which drives most of their profit. US regulatory pressure is particularly intense at 90%, followed closely by the EU at 85%. For the first time in decades, Google faces legitimate threats to its core business. The Microsoft OpenAI partnership has created a viable challenger to Google's search dominance. This radar chart highlights vulnerability across search, YouTube, cloud, and AI development, threats that simply didn't exist 5 years ago. Google's massive $75 billion AI investment creates significant near-term margin pressure without guaranteed returns. The company faces 5 key execution risks: uncertain AI investment returns, model competitiveness against GPT-4 and Claude, cloud profitability scaling, AI monetization timelines, and talent retention in a competitive market. The macro environment presents mixed signals for Google. High interest rates create headwinds for growth stocks, but strong cloud spending growth of 17.2% and robust AI service demand create tailwinds. Digital ad spending growth of 8.9% should support Google's core business, though competition for those dollars is intensifying. The smart money is cautiously returning to Google. After 2 quarters of net selling, institutions are net buyers again this quarter. With 86.8% institutional ownership and minimal short interest at just 0.55%, there's limited bearish positioning. This institutional buying suggests professional investors see value at current levels. When earnings drop, focus on these 4 critical metrics: cloud revenue, target 11.5B, operating margin, target 32%, ad revenue growth, target 11%, and any updates on Gemini 2.5 monetization. These 4 numbers will determine whether Google pops or drops after earnings. In the bull case, cloud exceeds 12B, margins improve to 33%, management provides a clear AI monetization roadmap, and regulatory concerns ease. This scenario gives us a 180-185 price target with 19-22% upside. I'd assign this a 30% probability, driven by earnings beats across key metrics and positive guidance. The bear case is ugly. Cloud growth decelerates below 11B, margins compress under 30% from AI investments, regulatory headwinds intensify, and search market share concerns emerge. This scenario points to $130, $140, representing 7 to 14% downside. I'd assign a 25% probability, triggered by revenue misses and weak guidance. Most likely, we'll see cloud revenue meet expectations at 11.3, 11.7B, margins hold steady at 32-33%, mixed regulatory news, and limited near-term AI impact. This gives us a $145-$165 price range, or roughly plus 8% movement. With a 45% probability, this scenario would feature inline earnings and stable guidance. So how should you play Google earnings? Conservative investors should wait for results before acting, then consider dollar cost averaging with a 25-25-50 approach. Aggressive traders could consider pre-earnings positioning or option strategies like straddles to profit from volatility. Just remember, options involve substantial risk of loss. Looking beyond immediate earnings volatility, Google's long-term outlook remains compelling. Revenue is projected to grow at 11% CAGR through 2029, while EPS should grow at an impressive 21% rate. Despite near-term challenges, AI integration, cloud expansion, and eventual regulatory resolution should drive substantial long-term growth. My verdict on Google is a hold with a 175 to 185 near-term target and 210 12-month target. Google's strengths are compelling: dominant market position, cloud profitability, strong AI foundation, exceptional balance sheet, and attractive valuation. But regulatory uncertainty and AI competition warrant a measured approach. For long-term investors, today's discounted valuation offers an attractive entry point, but prepare for volatility around earnings. That's my analysis of Google heading into this critical earnings report. If you found this helpful, hit that like button and subscribe for my post-earnings breakdown next week. I'll be diving into the numbers immediately after the report and updating my recommendation. Drop a comment with your own Google price prediction. I'd love to hear your thoughts. Thanks for watching.